It is April the 4th. Michael Vaughan with Brian Acker. Q1 is in the books for 2000. What a quarter. I mean, that dive in January scared the you-know-what out of me, yeah, but we're back.
First week of January.
Oh.
So I wrote about in December, the market was worried about two things. One was the cross rate between the US dollar and the renminbi, the Chinese, I guess what you call it, a peg.
Well, the fear was Chinese were going to devalue their currency.
Absolutely. So the world was convinced. Well, let's go back to August of 2015. The Chinese devalued that peg by about 3%.
Yeah.
That just caused everyone consternation. And even that devaluation of 3% back in August, that was the first loss this carry trade, which is calculated to be $9 trillion worth. That was the first loss they suffered in over 20 years.
Wow.
So just to give you a sense for how big a 3% move in that peg goes. Anyway, so the world was convinced, certainly going into 2016, that they would devalue. Some financial experts, certainly on the internet, thought 20 to 50% devaluation was in the cards. So what the world was trying to do back in January, obviously the first week of January, was price in what sort of devaluation was going to happen. Because if the Chinese devalued the renminbi or the yuan, what would happen is that would send deflation out around the globe.
Correct.
So their goods would be cheaper, therefore the world would basically buy their goods as opposed to other currencies which had been devalued. In other words, we get that trade or that currency war that everyone was talking about. So as the quarter, and as we predicted actually, as the quarter went on, we got a little bit more comfortable that that peg or cross rate would hold.
Mm-hmm.
The Chinese spent hundreds of billions of dollars defending it.
Yeah.
Certainly January fund flows numbers report that 150 to 160 billion dollars were spent by the Chinese buying US dollars to defend that the peg rate. So as we went through the quarter, the market got really comfortable that the cross rate or the Chinese would not devalue. The second thing,
the Federal
Reserve. What happened in September, the Fed,
mm-hmm.
with all the great fanfare and publicity, and after 2.5 years of talking about it, they finally raised rates. And they were making noises that we were going to have 4 to 6 rate increases for 2016. Again, as we went into the first quarter, everyone was nervous that what they were actually saying is actually what was going to happen. But as time went on, and certainly it was confirmed last week, where Janet Yellen basically said, we're taking rate increases off the table. Because what happened after the Fed actually increased rates in September?
1/4 of a point.
World growth just went. So we've really slowed down since the Fed hiked rates. But they were still making noises, and they still make noises today. Each independent Fed officials out there saying we're going to raise rates, and the market is truly concerned about that. So as those two issues, and again as we predicted as we go throughout the year, as these two issues get resolved, which it looks like they're largely resolved, the market will regain its feet again. So that's where we are going in.
But how good could it get if these fears are not to be worried about anymore?
Well, again, what we've seen, a lot of these companies, there's still a lot of companies with top-line earnings growth, and even though in aggregate, looking at the S&P 500 in terms of earnings growth, it is down quarter over quarter, but at the end of the day, what's your alternative? I mean, your alternative is 1% in fixed income.
No, thank you.
And 25% of the world, or world output, negative rates. So again, people are in this sort of sphere of looking for good companies, really doing a lot of analysis and hard work, trying to find either companies or segments of industry that are growing within this very challenged economy.
Well, to go back to where we started, though, so the performance for that first quarter, we're back where we started?
Yeah, so again, much of our performance back in Canadian dollars, I mean, part of the story on the Canadian dollar front was after we hit 68 cents, again, because of the peg, looks like the currency peg was going to hold, all of a sudden everyone went to risk on in terms of buying risk assets, and certainly Canada represented risk, certainly in January, but now, so we've had a rally in the Canadian dollar, but looking at our US Value 50 fund, so as of Friday, I mean, we were down probably 6.3%. As of Friday, April 1st, it includes April 1st, and the index is, our comparable benchmark is just under 4, so we're about 2% behind that. Canada we're flat in Canada after being down almost 10%, and the index is up 3 and a bit. So we're still behind, but again, from almost being down 10 to flat, literally in a month and a half. It's amazing. The other stat that's kind of interesting in the Dow Jones, since 1900, since the bottom of that quarter to basically the top, we haven't seen such a rally going back to 1900.
Wow.
In terms of a recovery rally. So just to tell
But is that just a sign of the volatility that we're going to suffer through this year?
I call it the cold-handed deflation. We have these periods where the cold-handed deflation is going to be on these markets. Now it manifested itself two ways going into 2016 with both the Fed and that cross rate. But even if the U.S. dollar peg, the U.S. dollar yuan peg holds here, that's not to say in the future it's going to come under stress again. So everyone's got their eyes on China, seeing what kind of goes on in the economy. But if China stalls out here again, I think we go back to what we did on certainly January 2016, where financial assets try to price in some sort of devaluation in the Chinese yuan.
So, well, I am not sleeping comfortably then.
Well, you just got to enjoy these times where there's nothing going on in the market.
Yes.
But again, that's not to say we can't preclude. Plus, I got to say this is an election year, so anything Congress is going to do, anything the world is going to do, they're not going to do it because we all know the U.S. election's coming in November. So, when you look at election years, they're actually good years.
Yeah.
Because basically everyone gets out of the way. No politician wants to be either painted or finger pointed that they caused the correction, certainly, of financial assets. So election years are usually good. And it should be quiet on the policy front between now and November, hopefully.
Good. Well, I've enjoyed the bounce back. I hope things continue positively, and I'll be in to see you in May. Thanks for your time, Brian.
Michael, as always, thanks for being here.